I'm Meghan Pinchuk, Chief Investment Officer, and I'm joined today by our CEO, Jeff Sarti. And this is our first quarter market review, and we have a lot to cover, so we're going to dive right into it. Markets have been extremely volatile. There's been a lot of big swings up and down, but punchline here is that our portfolios are holding up really well. We're really pleased with the performance kind of across the board, and we're going to get into the whys of it, but we are definitely positioned for this type of volatility in advance.
So should we just kind of dive into and talk about what's been going on in the markets of late?
Yeah, just some asset class highlights. So thinking starting first with the S&P 500, so the large US stocks. What we've got is we've had, again, big swings up and down. So through the first quarter, the market was only down about 4%.
Yeah.
Today,
well, that first quarter ended March 31st.
March 31st.
Liberation Day was
April 2nd, right? And so then that's when things really started to rock and roll.
Yeah.
And so we had at one point, I think the peak to trough decline was in the 20-ish% range in terms of how much it ran up and came back. Now today, which, you know, by the time people see this, we'll see where it actually ends up. Today, I think it's down closer to 6 or 6.5%.
Yeah, markets have rallied back in recent weeks a little bit.
Yes, and so again, big moves up and down, and so it's just been a lot. And that's on the U.S. side for stocks.
International's been a different bag. It's also been volatile, especially in the last month as tariff talks have heated up. But international stocks are actually up about 10%.
Yeah, big difference.
I was actually surprised when I saw that this morning. I thought it was up mid to high single digits, but up 10%. So again, international stocks are not immune to some of these risks we're going to talk about.
Right.
That being said, again, just shows the power of diversification, not just only being beholden to U.S. stocks.
And I think in normal times, we actually don't want to count on U.S. versus international stocks as diversifiers. Often global moves.
They move together.
Exactly. But in this environment, they've been really different. So it's we have a decent amount of international stocks versus our U.S. So it's been a really positive for our portfolio so far.
So what about other asset classes? How about bonds?
So bonds, traditional bonds, other kinds of bonds, it's been a mixed bag. So we are going to get more into that. But it's just important to remember, a lot of different asset classes in the portfolio. So including things like gold and private lending that have held up really well during all this volatility.
So we're going to dive into a little bit later in this discussion the talk around asset classes and how we think about portfolio construction. Yes. But really, what's on everyone's minds and the questions we're getting, it's around policies around tariffs. Tariffs. So let's just spend a few minutes talking about the context around tariffs, what they mean, the outlook on tariffs. Yeah. The bulk of today's talk will be more appropriate for clients in terms of how it affects their portfolio. But just for the next few minutes, let's revisit the rationale for tariffs as espoused by the Trump administration. It's really three main things. First, it's bringing manufacturing jobs back home. The second one is more around resilience. We are vulnerable to and depend on other countries for certain things. And then the last one is as a source of revenue, as a source of taxing revenue to bring more inflows of dollars to help bridge the gap of our budget deficit.
Right, theoretically reduce that deficit.
So those are the three. We'll hit on each of the three very quickly. On the first one about bringing manufacturing jobs back home, we understand the rationale. But from a long-term point of view, we question the effectiveness of that policy. And I think maybe history is a good guide in how to think about that, just even as a simple example. If you rewind the clock back, let's say 100 years or so, when we were more of an agrarian society moving to a manufacturing society, there was a lot of policymakers that were opining and really questioning the thoughtfulness around that. And should they protect farmers at the expense of moving into manufacturing?
Right. Farmers were very against that move.
Correct. The end result, and there were some protections that were put in place, but we really didn't take on that approach. Instead, we manufacturing a new way of doing things. We embrace, a new way of doing things.
Right. Move to manufacturing more.
And industrialization, and we became the global leader in terms of manufacturing. So that was the right thing to do, right? To embrace a new world order. Similarly, let's say 30, 40 years ago in the 1970s, 1980s, as we started losing market share in terms of manufacturing, instead of digging our heels in and protecting those industries, what did? We evolved and we embraced services and technology. Great example would be in the 1980s, Japan, at the time was the second biggest economy in the world. Lots of fear, concerns that they were going to take over in terms of becoming the largest economy in the world, specifically with autos. There was a lot that were really trying to protect our auto industry. That being said, we really didn't pursue those policies. We had minor tariffs, but they were very short-lived. And really good thing we didn't do that. Yeah. it makes sense. Japan's they grew their auto industry much more than we did.
Right.
We fell behind in the ensuing 30 years. But instead, what happened? We pursued other industries, and think about the Apples and the Microsofts and the Googles of the world that came out in the ensuing decades. So to pursue those policies that in many ways we think are backward looking, we understand the rationale for it. Yeah. But again, I think that ultimately results in stagnation and your economy not innovating over time.
Yep, agreed. And so the second one you hit on, the idea of we need to be more resilient as a country. Yeah. I think of all the different rationales, this one probably intuitively makes the most sense to us. Of the basic concept, right? In particular, the sectors of defense and healthcare. Right, those two in particular, but others as well, where you have essential things as a country that you need to have to protect yourself. Think of even in a COVID scenario, right, where everyone's now retrenching a little back to themselves. If you don't have some of these basic things, it's a big deal. Even beyond that, though, in defense, there was a statistic floating around where it was something like 78% of U.S. weapons have some component of them that are made in China.
They're made in China.
Yeah. So now it's like if you're gonna go like you need your enemy to manufacture weapons. That's maybe not the best plan. So that concept of like, there might be some short-term pain, but like long-term resiliency is important. I think it makes intuitive sense, but we'll get to the pain part in a minute, but that's, there are consequences to it.
And defense is a big one you hit on. Healthcare is another sector. We're really dependent on supplies from other countries. That leaves us in a vulnerable situation. The last one I'll just hit on quickly is around revenues. We've talked so much about budget deficits, right? Ever escalating debt levels. So theoretically, these tariffs will bring in a new source of revenue. But even by some optimistic estimates I've seen in the $100 to $200 billion range, no one really knows because the amount of tariffs are still in flux. But that will only put a minor dent in the $2 trillion annual deficits that we currently have.
So not hopefully a net positive, but the flip side is I don't think that's a rationale on its own for doing it, basically. There's other sources of revenue, potentially.
All right, so let's talk about now what's on top of mind of everyone, the concerns around markets and why are markets in somewhat of an upheaval of late. And it really comes down to a potential slowing of the economy and recessionary risk more than anything else.
Those are the two things. And I think, look, again, there's potentially, whatever the rationale is for a long-term standpoint, I don't think there's any denying that short-term there's going to be volatility that results from this. And so you hit on the two key ones. One is just prices going up. So the idea that, look, this is essentially a tax being put on these things. It will get passed through to the consumer in a lot of cases.
So inflation.
And inflation, and basically the prices of things go up. And then the other big one being, I think it meaningfully increases the odds of a recession short term.
And we're seeing this in real-time data. Just in recent weeks, there's data around uncertainty indices that are through the roof. The end result being, what are companies doing? So we're going to show a chart right here that shows an index of CEO confidence. And you'll see that confidence on the part of CEOs is absolutely plummeting.
And the reason that matters is because if a CEO is worried, right, or thinking, what am I going to do next? They're going to maybe hit pause on any growth plans. It slows everything down.
I'm glad you actually mentioned that. I was actually just on a recent call and part of a CEO study group. And a number of the companies are multinational, in nature. And one company was talking about its plans to expand its operations. The plan was to build a factory in Malaysia, completely on hold. They hit the pause button because they don't know what tariffs are going to be on Malaysia. Potentially they could shift to another country, even bring that manufacturing domestic to the United States. But no matter what they decide,
it's on hold.
It's on complete hold. So they've even shut down their hiring plans. I mean, complete paralyzation. So now that's fed into the consumer. The American consumer, and this is the next chart we'll show, similar looking chart, right? Really plummeting. And the end result of all of this, again, is potentially, again, concerns around recessionary risks. And when you think about now your portfolio and recessionary risks, stocks are vulnerable in this type of uncertainty.
There's a reason why uncertainty isn't just bad for portfolio. It's at the root, right? It's affecting how much do consumers spend, how much do businesses spend, and that's what leads to or trickles down to, I think, some of this market volatility.
All right, so do you want to start talking now about what clients are really asking about, how it affects them personally in their portfolios, and maybe we can even compare and contrast what our portfolios look like to a more traditional portfolio?
Yeah, look, there are a lot of headlines coming out right now related to foreign ownership of stocks and bonds. And so starting with bonds, actually, because that's the one I think that's really catching the headlines, is you've got treasuries where they're saying, oh, foreigners own U.S. treasuries now, either in retaliation or just because they need the cash, because they're worried, they're going to start selling treasuries. And so the statistics are that it's something like 25% of treasuries, outstanding treasuries, are owned by foreigners. So a significant amount. So they're definitely around the margins. There actually has been selling in recent years.
And the result of that is why people have seen yields going up as opposed to down.
Right. So when you sell the bond theory, that pushes interest rates higher. When you buy, it pushes them lower. So in this case, we have seen some selling pressure already, even prior to the tariffs. And so the concern, I think, is that accelerates. So is there more of it as a result of that? But even beyond that, too, it's just the concept that you are going to have, I think, just a lot of uncertainty where people are worried, should I buy more treasuries? Do I not? There's a lot more hesitancy, I think, around what's going to happen with the US dollar. Because the US dollar is still the reserve currency, I think our thought is that people won't kind of sprint away from it. This isn't going to be this massive crash as much as I think around the margins you see selling. And that, again, long-term has an impact. I don't know that short-term we're predicting that there's going to be a huge downward move in terms of selling pressure.
So you hit on bonds. And again, we have seen treasury rates rise, which has been concerning in recent weeks. What about stocks and foreign ownership of stocks?
And this is a little more counterintuitive. I think a lot of people are aware or concerned about the idea that, oh, China owns our bonds, as an example. But there is a big percentage of foreign ownership of the S&P 500. And it's grown. It's grown significantly. So back in 2011, it was something like 4 trillion of the S&P 500 of US were owned by foreign holders. Today, it's, I think, closer to 20 trillion.
Yeah, you showed me that stat like last week. I was blown away by that growth. What does that represent in terms of total US
about a
stock?
third.
So a third of US stocks are owned by foreigners.
Yes, and it's been a lot where, again, there's been a lot of, with interest rates being so low, money had to go somewhere. And so a lot of even central banks, foreign pensions were buying up US stocks. And so I think, again, similarly here, it's less of a concern that there's just going to be a mass sale and it's going to tank, but I think the pressure around the margins of people selling or even just buying less. There's a manager that we work with that just went on a tour of Europe and they met with all their pension plan investors. And they said the predominant theme was less around like, oh, we're selling our US stock holdings, and more around, well, we're just not going to buy as much this year, or we'll trim around the margins if we need it. But look, the market's been going up tremendously in recent years, and a good part of that has been all of the support, right? All of these companies selling essentially that are buying as markets have ridden up. And so that concept, if that slows meaningfully, that could really put pressure on markets as well.
And I'm glad you mentioned that example about that manager in Europe. Those are not necessarily adversaries in Europe. I mean, some of it is concerns around retaliatory actions on the part of our enemies selling our assets. This is not that. These are potentially even our allies that are saying, you know what, maybe US bonds are not the safe haven that they otherwise thought they should be. And in addition, US stocks maybe should be avoided.
Well, and again, I think a lot of these countries were thinking of US stocks as a safe haven, which I think is a little counterintuitive to us, given how we view stocks. But that's part of it. It was like, oh, the US, the market just keeps going up. And if there's questioning of that, again, there's a lot less money flow into it.
Okay.
So look, it's a challenging time for stocks. It's challenging to know exactly how to position yourself. I will say, though, that and we've seen this even recently, where the narrative, as much negativity or concern as there is around uncertainty, there's also a lot of potential upside to stocks, right? The risk to the upside, you can call it, where if the narrative slows, if the Fed cuts interest rates, whatever it is, you could see stocks take off again. So I think that's why we're definitely not advocating go sell all your stocks. You just have to have the right amount in the portfolio and be positioned the right way in case it gets volatile to the downside or volatile to the upside. You've got to have the right exposure in advance.
All right, so along those lines, let's talk about how we construct portfolios. And maybe we could show the viewer what a traditional portfolio looks like of stocks and bonds. And can you maybe start with stocks and how we think about how stocks are exposed to the risks we currently face?
Yeah, and so what we like to do is we'll look at different risk factors and how does each asset class potentially respond to those risk factors. So the main categories that we put these risks into are geopolitical risk, and we're putting tariffs in that bucket as well. You've got recession risk, so the idea that there will be a recession, inflation risk, as well as more valuations. So valuations of there and sort of how expensive is something going into potential periods of uncertainty. Okay. So high level stocks don't score well in any of these categories.
Across all four categories.
Across all four. And it's a little nuanced for certain of them, but overall, not great. So geopolitical, again, tariffs, we've seen this where in theory you could have stocks reacting very poorly in an environment where there's that kind of uncertainty. When it comes to recession, stocks tend to do earnings down, right? People spending less, stocks tend to do poorly during recession. Inflation's a little more of a mixed bag. Historically, inflation has been tough for stocks, but certain sectors where maybe there's more pricing power, sure, pass-through has been better for certain kinds. But overall, I would say inflation's negative for stocks. Right. And then look, from a valuation standpoint, we've been at very expensive levels for quite some time. And so the reason that matters too, we talk about this a lot, right? Valuations on their own don't cause a stock market correction, but the challenge is if you go into periods of uncertainty like this and you're already priced as if everything's going to be perfect and wonderful and rosy, and now all of a sudden, even if it doesn't get dire, but it gets not quite as rosy, you could see corrections in the stock market.
All right, so you hit on stocks, and a typical traditional non-Morton portfolio maybe will have, let's say, 60% in stocks. The other piece, bonds. Can you talk about bonds and those four same risks?
Yeah, traditional bonds, definitely some better stats here, are not quite as dire when you cross the board. Geopolitical type conflict, I would say this is one where typically, or in the past, I would have said, oh, that's actually good for bonds because bonds are a flight to safety. Similar to the discussion we're having though about like our treasury is going to be the safe haven. If that's not the case anymore, then that kind of risk or that kind of conflict actually could be negative for bonds. So this one I put a little bit more in the mixed bag category. Recession typically, same reasons, is good for bonds, where again, people are selling stocks, buying bonds. So that typically, at least in the past, has been a positive for bonds. The flip side is now inflation. Inflation is just bad for bonds. It's just a math thing where it's like if interest rates are high, people don't want to own a lower yielding bond. It's just not good math. The real thing I think to worry about that we're also seeing quite a bit in the headlines is a concept called stagflation, where you've got a recession, right? So the economy is declining and you also have inflation. So those two things combined, it could be a strange environment where you're getting a recession, but you're also getting inflation, and how will bonds respond to that environment?
Right. You're typically in a recession, yields drop, and the Federal Reserve can even drop yields to stimulate the economy. But in an inflationary environment, there's only so far that the Fed can lower rates to help stimulate the economy, because then that might juice inflation.
Yes, that's a really tricky spot for them to be in. So again, those will be somewhat of a mix. And then the last one, valuations. Previously when interest rates were zero, this was awful, flashing red. And so now that rates aren't quite zero, I do think it's better than it was previously. Still not amazing, or it's not like it's a screaming buy by valuation standards, but at least not quite as dire as it was.
So you hit on what a traditional portfolio looks like. And as we showed on the chart, stocks sort of flashing red, bonds maybe more of an orangish concerning color. So let's compare and contrast what a traditional portfolio looks like to a Morton portfolio that's more diversified. And I think this is a wonderful opportunity to really peek under the hood of how we think about portfolio construction. And really, this is not hypothetical, right? This is an actual life, real life case study. We've had, let me rewind the clock back. We had a brief moment in time in 2022 where we had a case study with interest rates rising and inflation rising. When the S&P 500 was down 18% that year, bonds were down 13%. We had a lot of other asset classes that did well. So our portfolio held up pretty nicely in that environment. Now, this environment is for somewhat different reasons. Yes, inflation is a part of it, but we're dealing with tariffs, geopolitical risks, et cetera. So the question is, how have our different asset classes performed? And you could see, again, on this chart, we have a lot of different asset classes that, knock on wood, are shades of green as opposed to shades of orange or red. The goal being to find asset classes that are just going to march to the beat of their own drummer and be more resilient in nature, right?
Yes, and green's my favorite color, so I like our chart better.
All right, so as a starting point, one of the biggest differentiations is just looking at the stock slice. Much less in terms of our portfolio compared to a traditional portfolio.
That is helpful.
So of course we're going to have stocks in a well-diversified portfolio, but instead of, let's say, 60 or 70% stocks, it might be 20 or 30% stocks. Bonds, you'll see again, we'll have some exposure to bonds too, but you'll notice a slight difference. Orange on the traditional portfolio, we have a slightly different approach in terms of how we invest in bonds. Ours is more yellow in color, not perfect, but a little bit more protected. Why is that? A couple reasons. One is typically we're not taking on long maturity or duration risks. Our bonds are shorter in terms of maturity.
So less exposure to high interest rates going up or down.
Correct. It's less downside if interest rates go up. Many of our bonds are even floating rate in nature, so we'll actually do better in rising interest rates. And then lastly, we're not quite as overexposed to corporate America at large in terms of the loans or bonds we invest in. There's some asset backing or other structural protections. So that's a differentiation on bonds. All right, so now I'm going to move to one of the green slices. Should we talk about gold?
Let's talk about gold.
Gold is...
This is a good year to talk about gold.
This is definitely a good year to talk about gold. Gold's done extremely well in this environment. And the truth is it's been a nice run for us for a number of years. I just look back in looking at the current decade, the 2020s. So going back to January 1st of 2020, the last 5-ish years, gold's actually meaningfully outperformed the S&P 500. S&P 500 stocks have been up a little over 12%. Gold's been up 15% per year over a fairly long time frame. Now, in particular of late, as we know and the audience knows, gold has really taken off year to date. It's up, I believe, about 24, 25%.
As of this moment.
As of this moment, it's been volatile. And in thinking through the 4 risks you talk about, gold performs well with regards to those uncertainties. If you think about geopolitical risk, tariffs, you think about recession, you think about inflation, you think about these things, gold tends to perform well in times of uncertainty. One last point I'll make on why it's done so exceptionally well, it goes back to your comments around bonds. Bonds have typically been the safe haven asset for the globe. They've been deemed the risk-free asset, central banks across the globe, that's their largest holding. But all of a sudden, when the risk-free asset is being issued by the country, America, that is actually the genesis or the cause of a lot of this risk, it hits back to the point that you made. Countries are not buying our bonds as much as they used to. So what are they doing instead? They're buying gold. They've always bought gold, but they're accelerating the pace at which they bought gold.
Makes sense.
So gold's been really a nice performer for us.
Yep.
All right, should we talk about, you want to move into real estate?
Sure.
All right, let's talk about real estate as an asset class.
Real estate, I think, was a little bit more of a mix from the standpoint that it is sensitive to some of these different risk factors. And it's very, real estate almost to some degree marches to the beat of its own drummer. It's very rate sensitive.
Yeah.
So it's been a challenging environment the last couple of years for real estate. When rates started moving up, it's to some degree short term, an immediate impact to some of those real estate asset classes. So look, fundamentally too, it depends on, are you in an asset class with, do you have fixed rate debt, versus floating? How much can your rents potentially increase over time? Like, for example, being in multifamily or apartments, there's the potential as people need a place to live for it to continue going up, your rents to keep going up to keep up with inflation. So inflation's actually one of all the risks where it can be a positive longer term for real estate. In the sense of geopolitical turmoil, those kinds of things, I think people like the idea of a real asset too. So in theory, it's a good buy in those cases. But depending on specific sub-asset classes, depending on locations that may have gotten overbuilt or something to that effect, there's definitely been short-term vulnerabilities. Long-term, we still like it. And if you're with a good manager who's hopefully being thoughtful to some of those short-term risks and you can ride through it, it should be a good place for investors.
You hit on a couple things. One, definitely some short-term volatility, especially, again, as you mentioned, real estate so interest rate dependent that the rise in interest rates in recent years has caused some volatility. Yeah. But typically, from an approach to protecting against uncertainty, real estate has been a real strong performer going back several decades. And you hit on the reason why, a couple things: people need a place to live. So that's a nice investment. An investment with more certainty around it. There's been a lack of supply really going back to 2008. Houses have been, and apartment buildings have been underbuilt. Yeah. And then lastly, you hit on the real asset component. In times of uncertainty, investors are looking for things that are real, that they can touch and feel in the here and now. That's in contrast to financial assets. Stocks are a great example where financial assets are a bet on the future. If you invest in a technology company, that's all well and good, but in essence, you're betting that that company will grow into the future. Right. Different than real estate, where you own something in the here and now that's cash flowing immediately. So there's always a balance between those two investments, real assets versus financial assets. in uncertain times, people tend to veer towards those real assets.
Yeah. And on those, one last point on real estate is just, I think we've definitely seen a divergence. Things that were more stable, right? Things that had either fixed rate debt or reasonable control of expenses have continued actually to perform really well. Yeah. That doesn't mean their price isn't down, because just looking at where interest rates are, people might have said, oh, if you had to sell it today, it would sell for less. Things that are a little more development focused or more midstream in terms of projects, I think that's where managers are going to need to be very thoughtful about getting through that to the other side so that they can benefit from some of these long-term trends.
All right, so real estate is obviously a core part of what we do. You hit on real estate equity or ownership of real estate. Now, the opposite side of that coin is real estate debt or private lending on real estate, which is a core part of what we do and has really held up nicely. Can you talk about that?
It has held up reasonably well. And I think one of the reasons, too, is when we're talking about this uncertainty, we want to be in real estate long term. But when there's this kind of short-term uncertainty, you'd rather be on the lending side, right? You'd rather be in a senior position, secured by the asset. And that gap between, what you think it's worth and where you're lending, is big. The bigger, the better. And so a lot of our managers, I think, have done really nicely navigating some of these challenges. There are one-off issues. There are going to be one-off issues. And that is why when you look at how we do real estate lending, you're building out a diversified portfolio where you're hopefully owning hundreds of these loans, not just a couple of bigger concentrations. So now if there are issues, you can work through them. The other key thing is not using leverage in that. So when we've seen actually real estate lending managers, not that we're with, but more broadly, get in trouble.
They're trying to juice up the returns.
They're trying to juice returns. So they borrowed a bunch of money to do more lending. And then the problem is in this kind of environment, if you have issues in the portfolio, you got to pay that back. And so now you're strapped. You have to go fire sale assets. Like you got to manage liquidity. And so that is a challenging environment versus if you don't have that, the pressure of that leverage you have to pay back. If you have to foreclose on an asset, take it back, update the business plan, like there's time to get through it without there being kind of that stress of like you have to pay the bank back basically.
So again, there's maybe been a little bit more volatility beneath the surface. This asset class has continued to perform very well for us.
It's been very solid.
All right, so an offshoot or an extension of private lending is we've done a lot more in recent years in lending outside of real estate. That's been a tremendous performer for us and very consistent and resilient. Can you talk more about that?
Yeah, it's something really too, and you hit on I know we talk about resiliency a lot. That was what we were looking for in this space was can you find other types of lending that are backed by other kinds of assets? Can we mix in different kinds of risks? Can you lend to different kinds of industries that will behave differently in different kinds of environments? I think that's what we're looking for when we talk about private diversified lending. And so we've given the example a number of times of like you lend to a company and it's based on the value of their fleet of trucks, right? So they've got these trucks and if the company does well and pays you back, great, we're happy. If not though, you're gonna go get their trucks and you're gonna sell them.
And it comes back down to even in the real estate example, your loan to value.
Right.
You're valuing the trucks and you're not lending 100 cents on the dollar, you're lending some smaller percentage for a cushion.
There's a nice cushion. And I think a lot of these companies that we work with have tremendous experience when it comes to if you have to go liquidate and sell down the assets that way, they know how to do it, right? They know where to go, they know how to get it done. So there's a lot of confidence too in some of these managers we've been with for a long time that if there's more challenges, I think they'll be able to work through it. This environment right now, and even as of a couple of years ago, when regional banks really pulled back from some of that lending that maybe they would have done previously, we've seen a lot of these managers tell us, look, we're getting better quality companies. And we're able to charge higher rates for it. And it's just the nature of there's less bank debt. So the best of the best companies are the ones coming out saying, okay, I need a loan. And previously, again, these private lenders wouldn't have gotten a look. The banks would have given them cheap debt, but now they're really getting opportunities.
We are seeing a lot of continuing to see a lot of exciting opportunities. We, along with some members of our investment team, have traveled the country with some really looking for new high conviction ideas and managers. We were in San Francisco a few weeks ago. We went to Florida a few weeks ago. We're going to Minneapolis.
Don't forget Minnesota.
And really excited about some of these opportunities we're seeing.
I'm mostly excited it's not going to be February in Minnesota though. So one example of an interesting opportunity that might not have been there a number of years ago is we're doing diligence right now on a group that likes to lend to technology companies that are in high growth mode and they've had some real success in terms of signing a new contract or they're getting ready to really ramp to the next stage of growth. And so they're trying to shore up. They want to show potential investors they've got a lot of cash, so they'll go out and try to get a loan.
So real quick, on the surface, that sounds very different than the types of loans we would typically make.
Yes, I think a lot of what we're used to is making loans to companies that might make it, might not make it, and you've got the assets in case they don't make it. So in this case, again, these companies are in have a big growth trajectory, but this group is still looking for meaningful asset coverage. So even though this company can show, look at my amazing growth, look at all my revenue, they're still saying, look, we want to have, in this case, 4 times coverage of assets, meaning that if they give them $25 million loan, they want them to have $100 million of assets. So assets too, like they might just be looking to like build up cash. So they might have actual cash inventory, they might have accounts receivable with high quality, basically people who owe the company money and good quality names. They even get personal guarantees from the founders, and sometimes they'll get like a pledge of their brokerage account, like liens against the brokerage account. So feels like there's a really good security cushion built in there, but again, it's a positive growth story. And in some cases here, you're getting warrants in the company, meaning that if it does continue to succeed and do well, and there's some type of a public offering, or even they sell the company, you could potentially have a little upside participation. So really interesting. We like the base case being like, we think the downside's protected, and our return without any upside we think is solid, but then beyond that there's additional upside, and that seems like a really nice profile.
I love that example. One, it's a diversifier too, right? Very different than other things that we're investing in. But to your point, it's nice to make loans to growing companies, but again, that's secondary for us. We're really in many ways agnostic to the underlying health of the company. Our concern is around the asset coverage. In that example, we have really good asset coverage with those loans. So with that, listen, this was a real nice talk. I hope for the audience that this was a nice look at how we think about constructing portfolios, and this contrast between what a traditional versus a Morton Wealth portfolio looks like, hopefully again was somewhat enlightening. If your portfolio looks like a traditional portfolio with, let's say, 60% in stocks, I don't know about you, but I would feel very unsettled by the vulnerability that an investor is exposed to.
It would make sense then to have more of a reaction to the headlines, right? You see a big drop in a day, and what does that mean for me?
Right. I mean, those headlines are very concerning, and we understand why they would be. But again, we want more than anything for the Morton Wealth investor to really understand that it's only a small slice of their portfolio that really is exposed to those risks, and we're in a lot of other asset classes that are going to be resilient in uncertain times. So with that, I enjoyed it, and hopefully you enjoyed it too. Please don't hesitate to reach out with any other questions.